Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. Thank you so much for tuning in. I know it's a confusing stock market for you to be part of right now, but for all of you who wrote to us over the last year almost, complaining that the stock market had run up such a lot and you just didn't know if it made sense to enter, well, here's your opportunity. Now, as always, we always recommend that you use an SIP, you don't put all of your money in one go, and that you invest systematically. But the big question on every investor's mind is, what mutual fund should I invest in? Well, this show will serve exactly that purpose. So I'm going to give you a second there to grab a pen and paper so you can write down the names of the funds we review and talk about on this show. And I'll tell you what we're going to do over the next half hour. We'll start by building a corpus of 3 crore rupees for a young man. We'll also question whether 3 crore rupees is going to be enough after 30 years. In our product review, we look at the UTI Balanced Fund and we'll tell a first-time investor how to start investing altogether. All right, so this is the part of the show where I get to invite Narendra Kumar onto the show. Narendra, thank you so much for joining us. It's an exciting time to be part of the Indian stock market, especially for a long-term investor like me. I'm putting aside retirement money, which means that valuations for large-cap blue chips are really attractive right now. So for any of our viewers, and there are a lot of them who've never invested in equity before or who pulled their money out and were waiting for the right opportunity, this is that right opportunity, isn't it?
The simple rule that to follow should be that you are investing your long-term money. Nobody has a control on the market, and it is extremely difficult to perfectly time it. In fact, somebody who has been waiting for last 1.5 years, one has missed the opportunity of nearly 60-70% or 80% gain, and now getting in with a 10% correction may not be a great idea. So my sense is that individual investors should have their plan. They have a full understanding of, for how long can they invest their money, when they are likely to need the money. And they have, no investor has any control on what the state of the market will be, which companies will disappear, which companies will prosper. So the other principle to follow is diversify, invest regularly. So these 3 things, if you do it, you are on track. If you are waiting for this 10% correction, use it as a catalyst, but use it to actually execute your plan, get started. There is always an inertia, but don't invest lump sum. 10% correction might translate into great disappointment if you invest a large sum of money right now.
All right, like always, never invest a large sum of money, ever. It doesn't matter what the market looks like. Always use an SIP, do it systematically, invest regularly, stay disciplined, and like Narendra said, diversify your investment across the market. Narendra, let's take a look at our viewer portfolio for this week. 29-year-old Armendra Sahu has written in, Narendra. He tells us he has a 10-month-old daughter whom he wants to plan for right now. Has a monthly income of 55,000 rupees. And he's asked us a very interesting question before we get into the details of his investments. He's given us his goals. He said he'd like to have 3 crore rupees at the present value after he retires in 30 years from now. For his child's education and her wedding, he'd like to save 20 and 40 lakh rupees each. And it always surprises me when someone saves more for a wedding than they do for an education, but that's his plan. He wants to know what the final value of these amounts will be given inflation over the next 20 or 30 years. So, Narendra, ideally for any investor who wants to ask that question, how should they arrive at those final values?
If today you have to retire and you think that the present value of you can retire with 3 crore rupees in hand, then 30 years from now that amount will be very significant. And just factoring it with 8% inflation will make it look like 30 crore. So be very liberal with your estimates of inflation. And given that you have 30 years, 30-35 years, your goals are 30-35 years away. It may not be very unrealistic, a small sum of money, because if you are able to beat inflation by a modest margin, you will be able to achieve your goals. So don't get upset with such big numbers turning up as your prospective goals or a goal which you are targeting, because with time in hand, you can well achieve them with a methodical plan.
Well, Narendra, if you look at his financial details, like any salaried person, there's the mandatory deduction going into his PF, but he also has a lakh going into his PPF every year. 1 lakh rupees in fixed deposit, that could just as well be his emergency fund, and he's going to start investing in the NPS this year. He has life insurance, he has a term insurance policy. He also has the LIC Jeevan Anand and a ULIP from ICICI, which he needn't really continue. And he has some very interesting mutual funds that he's picked out. Birla Sun Life Frontline Equity, Franklin India Prima Plus, iProof Focus Blue Chip, and SBI Blue Chip Fund. It does seem like a lot of the same thing. Would you like him to add maybe one more aggressive fund to his portfolio?
So if he wants to keep it simple, and if then this is not a bad portfolio. But I would say that he should be little venturesome, and he should definitely at least substitute his large cap funds with the multi cap funds, so that the fund manager is taking a call, and he does not necessarily have to ensure diversification across all kind of stocks. So that's the only suggestion I would say. And of course, after a couple of years, he should think in terms of adding mid caps, because mid caps can be very unnerving for some investors who are getting started. That apart, I think broadly he needs to really reconfigure his portfolio. And 2-3 suggestions I would like to make. One is that his PPF for his long-term goal may be very unwise. It might look safe, but it is not. Given that he has to save for next 30 years, he should substitute his PPF with tax-saving fund. 40,000 rupees going into his the mandatory provident fund deduction, so that is fine. I don't think he has a choice. He may consider increasing his term cover after he has discontinued his ULIP and endowment plans, and that is all that he needs to do. The money being saved by way of premium paid for the endowment and the traditional plans and the ULIP plans, I think should find its way into the long-term equity plans.
All right, so here's the advice you're getting. I'm going to give you a very quick recap. Now, from my end, I don't see any mention of health insurance, and I'd really like you to get a health insurance policy before you do anything else. You do need to bump up your life insurance cover as well, like Narendra said. Look at enhancing it a little bit. Exit the endowment and the ULIP plans. Reduce at least the allocation that's going into your PPF right now. It's redundant considering you already have a PF deduction. And Narendra is saying use a tax-saving mutual fund, which would be a better option if you're going for that PPF for a tax saving. And on your screen right now are the tax saving mutual funds we are recommending for this year. Here's an aggressive list, because remember, with your 30-year horizon, it does make sense for you to pick a few aggressive funds, so that might as well be your tax saver. That's on your screen right now. Right back to us if you need any more help. Welcome back. You're watching Investor's Guide in ET Now. It's time for our very popular fund review. And this week, we're looking at the UTI Balanced Fund. Avan will give you the latest numbers on the fund, and then we'll come back and talk about it. Avan.
Thanks for that, Faye. Under the scanner this week is the UTI Balanced Fund. The fund was launched in 1995 and has given a return of close to 16% since then. The UTI Unit Scheme 2002 was merged with the UTI Balanced Fund in 2006, and the fund has been managed by V. Srivastava since September 2009. The fund has barely managed to keep up with its category average in the 1, 3, 5 and 10-year periods, and it has mostly remained in the middle of the pack in terms of performance if you compare it to its peers. The fund is ranked 14 in its category in the 10-year period, but has been fast losing ground, with its ranking falling to 48 in the last 1 year. It has also underperformed its peers in the last 1 year by giving 25.38% returns, while its peers have given a return of 32% in the same period. So is that reason enough to get rid of this fund from your portfolio? Let's find out. With that, it's back to you, Faye.
Then they're talking about the UTI Balanced Fund. It seems rather unremarkable, but I am going to review this fund because there is still 1,267 crore rupees assets under management, which means there are investors who still have their money in this fund. It's so middle of the pack right now. It's so average. Does it make sense to continue to hold on to this fund given all of the other options we have within the balanced category?
No, there are superior options, and this fund has been consistently average, or sometimes below average. The only likable thing about this fund is that it has behaved like a balanced fund. It has kept its equity allocation conservative. It doesn't fall freely in a falling market, which is one of the key key expectation of a balanced fund investor. A balanced fund investor is generally, the pitch is, or the understanding is that give me growth, but don't give me a big decline. And that is what a balanced fund should endeavor to. And this fund does that job okay. But there are definitely, superior options. If we look at many other funds, this fund is not necessarily the best performing funds, and there are many funds which are, far superior performers, but they are not a desirable balanced fund. But we definitely have, far more far superior options in this category.
Well, if there's a viewer watching right now who's holding the UTI Balanced Fund, then we should assume that they bought it with the understanding that I don't want anything too flashy going on, because we've talked about the fact that there are some balanced funds in a certain market will almost behave like an equity fund. So if you were going to offer these viewers an alternative, so if I'm someone who wants a nice, steady, quiet fund, I'm in UTI Balanced right now, what is a similar fund with better returns that you can offer to me right at this point?
Superior balanced fund, I would suggest, Tata Balanced, Canara Robeco Balanced, and L&T Prudence.
All right, so if you're invested in UTI Balanced, they're saying that it might make sense to just pull your money out at this point. There are alternatives on your screen right now. Narendra, just to quickly wrap this up, what is your rating for the UTI Balanced Fund, given its average performance over the last couple of years?
Just an average rating, which is 3-star, because it is not a greatly disappointing fund, and it has never been an above average fund.
All right, 3 stars there for the UTI Balanced Fund on Investors Guide. Now, if you'd like us to review a fund that you're holding or that you're interested in, write to us. Our email ID is at the bottom of your screen. You can reach me on Twitter as well. It's time to move on to our hold or sell segment. Well, Hussain has written in, Narendra, he's 28 years old. He's just married. Congratulations, Hussain. He wants to save for his retirement and his children's future. He'd like us to review his portfolio. He's saying he'd like to hold these funds for the next 20 to 25 years. And he wants to know if this list is the best list for it. First on his list, Axis Long-Term Equity, Narendra. I know you're going to agree that it's a good fund. Should he continue holding on to it?
Yes, absolutely. In fact, today, if I have to recommend a tax-saving fund, this will definitely, be the first thing I'll recommend.
But it does seem like he's put his entire portfolio together based on recommendations he's heard on this show. The next one on his list is a Quantum Long-Term Equity. So while Axis is a great tax-saving fund, this one has its own advantages with its low charges. Would you recommend he continues his SIP?
Quantum Long-Term Equity is an impressive fund, and not only for its low cost, but also for its, taking a very conservative approach to managing equity, and also many a times it could be disappointing when it takes a cash call, when it thinks that, its valuation model is not favorable, the valuation of the market overall is not favorable for it to be fully invested. And that's a time when, it loses out. And it could be quite disappointing when other funds are racing ahead and this fund is, a laggard, so to say. But on a full market cycle, I think it should compensate. So here is a fund with a conviction and a belief, and it follows that. So definitely worth carrying on with your SIP.
Well, the next on his list is the Franklin India Prima Plus Fund, Narendra. He has 5,000 rupees going into, this fund. And also, for some reason, he puts in a lump sum every time there's a drop in the market. First of all, should he continue? And I know that you think it's an impressive fund, but this business of putting in a lump sum every time there's a drop in the market, is that a strategy that you would recommend?
I'm quite amused by, his whole approach to the way he has stated that, he makes a lump sum investment every month. So basically, he's doing a SIP, but he has decided to make that investment on a day of, his choice. So in that sense, if he's actually deriving fun, he should carry on. But make sure that, till the last day, if you think it's not a good day, you make that investment anyway. So there is some discipline enforced.
And finally, Narendra, I'm going to take these two funds together, L&T Prudence Fund and the L&T Equity Fund, both about 5,000 rupees going in, into one of them through an SIP. The other one is the lump sum, I choose the day sort of format. Continue those investments as well?
Yes, continue these two funds as well, though I don't see a role of a balanced fund, given that, he is investing for such a long period of time and he's going to be a disciplined investor. I would look at it that, he has a nominal fixed income allocation by way of this L&T Prudence Fund, and nothing beyond that.
All right, and finally, he does have a ULIP from ICICI that he's bought. He puts in about 20,000 rupees an annum. He's held it from 2009, which means it's past that 5-year lock-in that we should normally worry about. Would you recommend he exits that ULIP, Narendra? He hasn't given us any specifications about how much money has gone in or how much money he'll get out at this point. What would you recommend he does?
He should definitely surrender this ULIP policy. It's not needed. And before that, he should ensure that his insurance needs are covered, and that should be achieved with a term plan. And whatever lump sum he's able to derive from this, he should spread that money in his his great selection of mutual funds over the next 3-4 months. Just average it. Don't invest that money lump sum.
Narendra, I want to very quickly address this one last question before I let you go. Shiv Kumar has written in. He is 49 years old and he's going to be retiring in 11 years. Now, he tells us that he'd ideally like a monthly income of about 50,000 rupees when he retires. Right now, he is investing in the HDFC Tax Saver Fund in the dividend option through an SIP of 5,000 rupees. He says he reinvests the dividend to exhaust his ATC limit. He says, is the dividend a better option than the growth option? What should I be doing with the returns? He also wants to know if he should be investing in HDFC equity and top 200 over the next 10 years. So there seems to be a lot of problems in the way this entire investment is structured. If he's looking to accumulate over the next 11 years, he should not be using the dividend option. And investing the dividend to save tax does seem counterproductive, because if he holds it for longer than a year, then it's tax-free anyways. What would you recommend he does?
Being open-end mutual fund, you can realize your money and the amount which you want, or you can look at it that how much money, what is the appreciation component of your money. You can take that out any time of your choice. So in that sense, you can derive your dividend any time after 1 year and in a fairly tax-efficient manner. So dividend from mutual fund do not make sense.
All right, so the advice is very, very clear. If you're looking to accumulate money over the long term, whoever you are, do not pick the dividend option at all. Just go for the growth option. Just trust us when we tell you that it's the better option for you. Narendra, he has 3 funds right now. He's already investing in HDFC Tax Saver. He'd like to include HDFC Equity and Top 200. Instead of it being both of that, would you rather he just picks one and goes with it?
Yes, I think so. And, he should, tax saver, it is important to, fully utilize your ATC tax break which is available, which is to the extent of 1.5 lakh rupees every year. Beyond that, diversify. So maybe you choose HDFC equity and one other fund, split your money. So you are diversifying across style, across the skills of fund managers as well.
All right, so that's the advice you're getting. And before we let Narendra go, here's a recap of the most important things we learned on the show today. Always use diversified equity funds. Always use an SIP. Always pick the growth option. And that's across all investors right now. Anybody using a mutual fund, these 3 rules apply to you as well. Narendra, thank you so much for answering our questions on Investor's Guide this week. We look forward to having you back again soon. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. I've asked Gajendra to join us again this week because we got so many questions. Gajendra, thank you for joining us. Banu has written in, wants to know where he should be investing his emergency fund. Should he put the money in a liquid fund? Is that a good idea? Or should he pick the dividend option or the growth option? That's a question that keeps popping up. Let's first just address this. Anybody who has cash right now in hand that they'd like to set aside for emergencies, what is the ideal investment for that money?
Hello Bhanu Prakash. I think it's a great idea to put your idle money into liquid funds, particularly the emergency fund which you talked about. Either you have the option to keep in your savings account, but there you will only getting 4%. If you can park in liquid funds, you can roughly expect around 8% return per annum as long as your money is parked. Now, how much money one should keep? So if you are a salaried person, then make sure that 6 months of your monthly expenses is tucked away into a liquid fund. Or if you're a businessman, then it's a little more riskier because you can have uneven times in the short term. So there we would recommend at least 12 months of expenses should be parked in a liquid fund. And the beauty of liquid fund is that you can exit in a day's notice. Next day morning you get money into your bank account. And whether you should go for a dividend option or growth option, well, it's quite simple. You must go for the growth option because in dividend option you will be charged dividend distribution tax, which is at 27%, which is very high. Even if you are not in any tax bracket, you'll have to still bear the DDT because that's charged at the mutual fund level. On the other hand, if you go for the growth option, whenever you withdraw, the gains is added to your nominal income and you're charged as per your tax slab. So you must go for the growth option.
Our next question comes in from Rinal Kaur, who's 23 years old, and she saves about 7,000 rupees every month. Now, she started a recurring deposit of 3,000 rupees for 15 months. I hope you have a good plan for that money when the 15 months are done, because a lot of times what happens is recurring deposits mature, the money comes back to your bank account, it just sits there for a couple of months not earning anything. So if you set 15 months, I hope there's a goal at the end of it. Now, she wants to start investing mutual funds for the long term, and I'm so pleased to hear that. She says, please give me a couple of suggestions because I can take some risks. I want to invest for the long term. Gajendra, could you give her some tips for someone who's starting off into mutual funds to invest for the long term?
I would recommend you, if you can start with balanced funds, wherein 65% of your money goes into equity and remaining 35% goes in debt. That will give you some confidence into mutual funds, and the track record has been phenomenal. You can expect around 12% return per annum by investing such kind of funds. So one part of your money, of 7,000, I think something should be there. Around half money should be there in balanced funds. The remaining half you can put in a diversified equity fund, wherein your entire money is invested in top 100 companies of India. So though you said you want to take high risk, but I would recommend to at least go slow right now. First have the experience of these two, and then at a later point of time in the future, when you have confidence, you can increase your risk appetite. The funds which you can invest in balanced funds, you can consider investing one of these funds, HDFC Balanced Fund or Birla Sun Life 95 Balanced Fund. With regard to diversified equity fund, you can consider investing in quantum long-term equity fund, which is the lowest expense ratio in the fund, which is what you wanted, and or you can invest in funds like HDFC Top 200 Fund or Birla Sun Life Frontline Equity Fund, which also has very low expense ratios.
All right, so remember, we will tackle any problem you have, whether it's your credit card, your home loan, your credit history, or your mutual funds. Write to us. Our inbox is open. Email ID is on your screen. My Twitter handle is on your screen as well, so you can get in touch. Let me know what you think of the show, if you have any suggestions or if there's something in particular you'd like us to talk about on the show as well. Thank you so much for watching.